So today we're going to talk about how deals are flowing in, many are toxic, and you need to be careful that you don't catch a falling knife. So make sure you stay to the end, because I believe this is the biggest threat to the real estate industry, and it's not single family, but it's commercial mortgages that are coming due and about ready to mature. So one of the biggest issues I'm seeing right now is a lot of these banks that are already in a little bit of trouble have commercial mortgages coming due when a lot of these property values are actually less than the mortgage itself. So two things we're going to talk about in this video. The first one, what is the Fed doing? And the second one, of course, what are the banks doing, and what are their big concerns in 2023 and 2024? So most of you know that the Fed has increased interest rates 9 times since March of last year, and it's only reduced the inflation rate about 3%. Their target is 2%, and we're currently sitting at 6%. Chairman Powell has said over and over and over that he's very concerned about inflation, and he's trying to decrease this asset bubble, which is definitely happening in both the single family and really happening in the commercial markets. So most of you follow the single family market. In the commercial market, we have serious issues because the capitalization rates, which we're going to talk about later, have gone up, which have severely affected many of the values. So let's first talk about the basics. Every single deal has the same math formula. You have your income. In many commercial properties, this is your rent or other things that might be income. The second one are the expenses, and those are under attack too, with property taxes, insurance, and utilities, and all kinds of labor and supplies. So these two things are actually in jeopardy right now, but for this particular video, we're just going to say that they're the same from year to year. But as you dig deeper, you're going to see that many properties are struggling in these two areas. Specifically, if you think about it, commercial office buildings where a lot of people are not coming back to work and they're having high vacancies, therefore the income's low, where the expenses are the same or more, which results in less net operating income. So if you're a bank that holds an office building, for example, and you have declining income, higher expenses, you're actually concerned when that debt is due. So the biggest issue by far is going to be the debt maturity that's coming for many of these commercial mortgages. Just consider a moment, if this property had the debt maturing, it would now have to go to the open market and get a value based on the existing operations, which is really based on the net operating income. So all debt, all mortgages are based against what the property makes, which is the net operating income, or NOI. If this is lower, your debt will be lower. If you're a little confused, it's okay. There's another video I did on debt service coverages that talk about how a bank sizes their debt against the asset itself. Because as you would imagine, as you would do yourself, you're not going to lend a lot of money on something that doesn't have a lot of income. So what is the biggest threat to these banks? It's the rise of the interest rates. These interest rates have almost doubled. So not only do we potentially have problems, higher debt costs are going to create cash flow issues right here. So if this property, let's say, has a variable rate loan and the debt costs have gone up over this past year, there's no question that their cash flow has been impacted and could be even negative. So the banks are going to be looking at the cash flow, the cash reserve. So even if you have a lot of cash on hand, you're probably funneling it in to this property to try to save it from actually going back to the bank. So quietly, a lot of these properties are being shopped around. And I'm talking about retail, office, industrial, multifamily, all kinds of them are quietly being shopped around because of the debt is maturing either this year or next year. And they know that these interest rate increases have increased their debt, and therefore they're going to get less of a loan. So as a general partner or an owner that has maturing debt, they could be doing cash calls to try to keep the property in the short-term basis, bringing in new money or bringing in money from the existing limited partners, or they might even be trying to sell. And all of those are options happening right now on a number of properties all over the place. But that's not all, folks. The one thing that you have to know with rising interest rates is that not only is cash flow down, which we just explained in the prior slide, but cap rates are also up. So capitalization rates are used as a valuation, as many of you know, against the net operating income to determine what the property is worth. If you're a little confused about what a capitalization is, then just take a look at some of my other videos. I go into a lot more detail, but just know this. As interest rates go up, cap rates also go up, which basically just means that the properties are being sold for less money, and the cash flow is definitely down on these properties because a new person trying to buy something is actually solving to cash on cash or return. And as debt goes up, cash flow goes down for the new buyer, and therefore they're offering less money for the exact same property that they would have tried to buy a year ago. So now let's talk about a real life scenario. Imagine that a property had $2 million in income, $1 million in expense, and they had $1 million of a net operating income, and their debt payment was, say, $700,000, and they had a cash flow of about $300,000. Now the loan matures, the exact same property, $2 million in income, $1 million in expense, $1 million in NOI, and because of the new interest rate, which is almost double, we put the debt around $1.2 million. Now that same property is looking at about a $200,000 a year negative cash flow. That is not going to happen. The lender is never going to do this deal because, as I said before, how they get paid back is the net operating income itself. And that also assumes that the net operating income holds at $1 million. As I told you before, we're also battling those issues by just keeping tenants into some of these buildings. So how would a lender take a look at this building? They would look at the net operating income and they would apply the cap rate. That would be one type of valuation. So if we took $1 million of net operating income and used a 4% cap rate, we would have a value of about $25 million. But as cap rates have gone up from 4 to 5, and they have, that value has dropped down to $20 million. It's simply just taking the 5% and dividing it into the million, or the 4% dividing it into the million. So in theory, this property has dropped in value at about 20% as a result of the interest rate increases. So now let's take a look at what this really means. I was just looking at a property yesterday with our investment committee where we actually did all the work, all the underwriting. We took a look at a very cool building that we would have loved to buy just a year ago with lower debt, and we realized that the loan was actually higher than the property was worth today. Now, this property is not listed. It's actually being shopped around to a bunch of people because, of course, the syndicator, the general partner, is trying to keep it from going back to the bank, because right now, currently in today's environment, the loan is actually higher than the property's worth. So there's two things that we look at. First, what is the current loan balance? And second, what is the current value? And the value, of course, is based on whatever the capitalization rate is at the time, and of course, based on the debt quote that we can get based on the cash flow. As you guys know, the interest rates are a lot higher, and therefore the mortgage payments are a lot higher. So you're just using simple math, you have to offer less to be able to accommodate the higher debt cost. Using that same methodology with a $1 million NOI and a 4% cap rate, we come up with a value of about $25 million. Well, this particular property had a $20 million loan in place. At the time, the investors put up the other $5 million in equity. Let's fast forward 1 year later using the exact same NOI, and you can see using a 5% capitalization rate, the actual value is about $20 million. When you look at that based on the existing loan, you can see that there literally is no equity. So one of the things that we said in the meeting yesterday is that the limited partners don't actually realize today probably that all their equity is gone. And why is it gone? It's gone because the interest rates and the cap rates have gone up and the cash flow has gone down. It's that simple. As the debt is maturing or these properties are trying to be sold, recapitalized, or even refinanced, this is exactly what the lenders are going to look at. They're going to look at the value versus the loan and then reconfigure the equity. So the biggest threat to real estate in 2023 and 2024 is literally these loans that are maturing and these cap rates that have gone up. The Fed continues to raise their federal funds rate and the interest rate continues to go up, then these problems are just going to continue to get worse.